2003. 10 of Wall Street's biggest firms paid $1.4 billion in fines. Henry Blodget, Merrill Lynch's top internet analyst, was permanently banned from the securities industry. Jack Grubman at Salomon Smith Barney, same result, banned for life. Their crime: recommending stocks as buys in public reports, while their own internal emails called those same stocks, quote, dogs and junk. Recommendations presented as objective facts. The analytical basis, corrupted by investment banking revenue pressure. Records that could have proven their process, non-existent. This is what Standard V exists to prevent. Diligence, communication, record keeping. 3 obligations, 1 integrated system. Standard V has 3 substandards. V.A. Diligence and reasonable basis. You must have adequate grounds before making any investment recommendation. V.B. Communication with clients and prospective clients. Every statement must be clearly labeled as fact or opinion, no exceptions. V.C. Record retention. You must preserve the records that prove your diligence and the basis for your communication. The exam tests all 3. But it tests them with specific traps that most candidates walk straight into. We're going to close every one of those traps right now. Standard V.A. requires a reasonable and adequate basis, supported by appropriate research and investigation, before making any investment recommendation or taking investment action. The exam tests exactly one thing here. Diligence does not mean independence. You do not need to conduct original analysis. You need grounds to believe your recommendation is sound. A credible third-party report with a sound methodology from a reputable source that satisfies V.A. Think of it like a general practitioner who sends you for an MRI. The GP doesn't read the imaging themselves. They rely on a credentialed radiologist. That's not negligence. That's appropriate reliance on expert input. The GP only fails their duty if they use a radiologist known to be incompetent or conflicted. When you receive third-party research, run this 3-step test before relying on it. Step 1, is the source reputable? Does the firm have a credible track record? Is the analyst known for sound work? Step 2, did you review their methodology? You don't have to rebuild their model, but you need to understand how they reach their conclusions. Step 3, is there a material conflict of interest? Does the vendor's analyst own the stock? Are they being paid by the company they're rating? All 3 pass. V.A. compliant, you can rely on it. Anyone fails. You need independent verification or a different source. This is the Fuentes case in your exam materials. He had a conflicted third-party source. He used it anyway. That's a V.A. violation. This is the most commonly confused boundary in all of Standard V. V.A. versus Standard I.C. misrepresentation. The exam will give you a plagiarism scenario and ask which standard was violated. Most candidates write V.A. The correct answer is I.C. Here is the boundary. I.C. is the attribution question. Whose work is it? If you present someone else's research as your own without attribution, that is I.C. plagiarism, misrepresentation. V.A. is the quality question. Is the work sufficient? If your research process was inadequate, too thin, not thorough enough, that is V.A. These are orthogonal. A plagiarized report might have an excellent analytical basis. I.C. violation, no V.A. issue. Your own terrible research satisfies attribution, no I.C. issue, but a V.A. violation. They can also both occur simultaneously. Standard V.B. requires members to distinguish fact from opinion in all communications. The exam tests exactly one thing here. Price targets are opinions. Not facts, opinions. An analyst writes, the stock will reach $95 in 12 months. That statement violates V.B. It presents a future projection as a certainty, as a fact. The correct version? Our 12-month price target is $95, based on a 15x forward P/E applied to our FY 2025 EPS estimate. This is a projection and may differ materially from actual results. Same number, completely different treatment. The crystal ball test. If you need a crystal ball to verify it right now, it's an opinion. Earnings estimates, price targets, performance projections, all opinions. All must be labeled. Another boundary the exam loves to test. V/B versus Standard Roman III-B fair dealing and V/B versus Standard Roman III-C suitability. These are completely different obligations, operating on completely different dimensions of a research report. V/B governs the content of the report, how facts and opinions are labeled, what risks are disclosed, what assumptions underlie the analysis. Roman III-B governs the distribution of the report, who receives it and when, simultaneous distribution, fair dealing. Roman III-C governs whether a recommendation is appropriate for a specific client, their risk tolerance, their investment policy statement, their individual circumstances. On the exam, when you see an answer choice about distribution timing, eliminate it from V/B questions. That belongs to Roman III-B. When you see an answer about client-specific suitability, eliminate it from V/B questions. That belongs to Roman III-C. Standard V/C. Record retention requires members to develop and maintain records that support investment recommendations and actions. The exam tests exactly one thing here. There is no 7-year minimum in Standard V/C. Say it again, no 7-year minimum. The standard says, maintain records for a period consistent with applicable regulatory requirements, or your firm's stated policy, whichever is more demanding. 7 years appears in GIPS composite records. 7 years appears in IRS tax rules. 7 years appears nowhere in the text of Standard V/C. Where does the CFA guidance mention 7 years? In the recommended procedures as best practice, not as a binding requirement. On exam day, find the applicable regulatory requirement, find the firm policy, take the larger number. That's your binding constraint. On the exam, every record retention question follows the same decision path. Step 1, what does the applicable regulation require? Find the number the question gives you for the regulatory minimum. Step 2, what does the firm policy require? The question will tell you there is no policy. Step 3, take the larger of the two. That is the binding V/C requirement. Step 4, if neither exists, the CFA guidance recommendation of 7 years applies as best practice, but the exam will typically specify a regulation. One more critical rule, V/C is an individual obligation. The fact that your firm has no record retention policy does not relieve your personal obligation to comply with applicable regulations. You cannot outsource your V/C duty to your employer's compliance department. And electronic records are fully acceptable, format neutral, paper, PDF, cloud storage, all compliant, as long as records are complete and retrievable. First exam question. Julia Ramirez, CFA, issues a buy recommendation on Meridian Corp based entirely on a research report from a well-known sell-side firm with a strong track record. She does not conduct independent analysis. Has Ramirez violated any CFA Institute standards? Think about what V/A actually requires. Remember the distinction between diligence and independence. Before the next questions, lock in the 2 single-sentence decision rules you need for exam day. V/A decision rule: when you see analyst uses third-party research, immediately ask, is the source reputable and conflict-free? If yes, no V/A violation. If a conflict exists, violation. V/B decision rule: scan every forward-looking statement in the report. If it says will or any future certainty without a qualifier, that is your VB flag. These two rules alone resolve at least half of all standard V exam questions. Second question, standard VB. A portfolio manager writes, the stock will outperform the S&P 500 by 15% over the next year. No qualifier, no disclosure, just a flat statement. What standard, if any, has been violated? Use the crystal ball test. Now the hardest V, C. Question the one where both the regulatory requirement and the firm policy are given to you explicitly. Remember, take the larger. That is the binding constraint. The 7-year number does not appear anywhere in the question because it does not belong in standard V, C answers. Third question, the record retention trap. Helen Park works at a firm that requires records to be kept for 5 years. The local securities regulation requires 3 years. After 4 years, Park deletes her research notes, citing regulatory compliance. Has she violated standard V, C? Read the scenario carefully. Both numbers are given to you. Which one controls? Third question, the record retention trap. Helen Park works at a firm that requires records to be kept for 5 years. The local securities regulation requires 3 years. After 4 years, Park deletes her research notes, citing regulatory compliance. Has she violated standard V, C? Read the scenario carefully. Both numbers are given to you. Which one controls? 2 more questions. These test the hardest boundaries. Quantitative model reliance under V, A, and the plagiarism versus diligence boundary between V, A, and I, C. These appear on virtually every exam administration. For quantitative models, the appearance of rigor does not substitute for understanding. A sophisticated internal model approved by qualified quants does not transfer the intellectual basis to the analyst using it. For plagiarism, the violation type is determined by what went wrong, attribution, or quality. These are different questions with different answers. Fourth question, quantitative models and V. A. Sandra Ackafer uses her firm's proprietary quantitative model to generate buy and sell signals. She doesn't fully understand the model's assumptions. She issues recommendations based solely on these signals. The firm approved the model. Qualified quants built it. Does that satisfy V, A for Ackafer personally? Fourth question, quantitative models and V. A. Sandra Ackafer uses her firm's proprietary quantitative model to generate buy and sell signals. She doesn't fully understand the model's assumptions. She issues recommendations based solely on these signals. The firm approved the model. Qualified quants built it. Does that satisfy V, A for Ackafer personally? Final 2 questions test V, A in its most nuanced forms, quantitative model reliance, and the simultaneous I, C plus V, A trap. These are the questions most exam candidates get wrong because they look like they have an obvious answer. They do not. Fifth question, the plagiarism versus diligence boundary. David Nguyen plagiarizes an economic forecast from a government report, presenting it as his own analysis. He also fails to independently verify the data. 2 actions, 2 potentially different violations. Which standards apply? Fifth question, the plagiarism versus diligence boundary. David Nguyen plagiarizes an economic forecast from a government report, presenting it as his own analysis. He also fails to independently verify the data. 2 actions, 2 potentially different violations. Which standards apply? Screenshot this. Standard V cheat sheet. Everything the exam tests, organized so you can recall it in 3 seconds. The DCR mnemonic, diligence, communication, records. You need all three, know what you're recommending, say it clearly, keep the proof. For VA, reasonable basis does not require original analysis. Third-party reliance is acceptable if the source is reputable, the methodology is sound, and there is no material conflict. For quantitative models, you must understand the assumptions, trusting the output is not enough. For VB, the crystal ball test. If you can't verify it right now, it's an opinion. Price targets, EPS forecasts, return projections, all must be labeled as opinions or estimates. For VC, no magic number. Max of applicable regulation and firm policy. Electronic records are fully acceptable, format neutral. VC is an individual obligation, no firm policy does not excuse you. And the two critical boundaries, VA versus IC, attribution is IC, quality of basis is VA. VB versus Roman 3b, content is VB, distribution timing is Roman 3b. Exam strategy for standard V questions. You have approximately 90 seconds per ethics question. Standard V questions usually resolve in 60 seconds or less if you apply the right filter at the start. First filter for VA, when the question says analyst uses third-party research, immediately check for a conflict of interest in the source. Clean source, reviewed methodology, no violation. Conflicted or suspect source, VA violation. When you see plagiarism, go to IC first, not VA. Ask separately if the basis was also inadequate. For VB, scan every statement in the stem. Does it contain future projections presented as certainties? Will, shall, is certain too? That is your VB signal. Eliminate any answer about distribution timing, that's Roman 3b. Eliminate any answer about client-specific fit, that's Roman 3c. For VC, read the numbers carefully. The question always tells you both the regulatory requirement and the firm policy. Take the larger number. Never assume 7 years without explicit support in the question. Final tip, VC. Answer choices that say firm-level obligation only or individual has no obligation are almost always wrong. VC is a personal obligation. One final frame to lock in how standard V fits the full CFA ethics picture. The highest frequency exam traps in standard V form a clear hierarchy. The most tested trap, assuming VA, requires independent analysis. It does not, it requires a reasonable basis. Third-party reliance is permitted. Second most tested, presenting a price target as a fact without labeling it an opinion. VB requires the label, always. Third, the 7-year myth for VC. There is no fixed number. Follow applicable regulations or firm policy, whichever is more demanding. And the two boundary traps, VA versus IC and VB versus Roman 3b, are reliably tested at least once per exam administration. Know these boundaries cold.